So welcome back to another session. For this session, what we'll be continuing to do is we are continuing to look at financial assets, and we'll just recap what financial assets are. And these are non-physical assets whose value is derived from a contractual claim, such as bank deposit, bonds, and stocks. They're usually more liquid than other tangible assets, right? They don't include cash only, but also other assets that can be easily converted to cash. From our understanding is that they're shown in our balance sheet and they're shown at their current values. And two examples of those includes cash, marketable securities, and receivables. So last week, or in our most recent videos, we looked at cash, the financial assets, and we narrowed into what we call the bank reconciliation, right? But this week, we'll be focusing on our accounts receivable, right? Or debtors. And what is this? So our receivables are money claims against other businesses and individuals arising from the selling of goods and services on credit or lending money. So essentially, this is your goods or service that you sold on account, and on account, we said on account means on credit, that results in the creation of accounts receivable. So I have a business that sells banana chips, and I sold Mary 10 banana chips. However, Mary did not pay me immediately. So I sold her these banana chips on account or on credit, right? This created an accounts payable. This is monetary claims that I have against Mary, right? That she will pay me in the future. So our accounts receivable, they're classified as a current asset in the balance sheet. But pointing out is that some accounts will be uncollectible. And what this is just that in life, persons will borrow from you and will credit from you, but you might not get paid. So that's the risk. So some of your account receivables will be uncollectible. And so we refer to those as uncollectible accounts expense, or another name is doubtful debt expense. So you doubt you're going to get it, or bad debt expense. So that's a debt from your debtors that has gone bad. And underline there, we see that this is a normal expense. This is a normal thing for any business that sells on credit. So our account receivable should be shown in our balance sheet net of the estimated uncollectible account. So what that means is that we need to provide for these uncollectible accounts, right? And show the net realizable value. So yes, we know that maybe together you had 1,000 accounts receivable, $1,000 worth in outstanding cash. But remember, some of these accounts will be uncollectible. Some of these persons may not pay us for more than one reasons, and we therefore need to provide for that and to show the true value of this asset, the true value of our accounts receivable. So with that, we need to learn how to account for the uncollectible receivables. And there are two ways in accounting for uncollectible receivables. One, we have the allowance method, and two, we have the direct write-off method. So the allowance method. The allowance method is based on an estimate of collection losses. So this estimate can either be a percentage of the sales that you made or based on the aging of the existing account receivable. So here in this method, what we're really doing is just saying, okay, let us make an estimate of what we think will be uncollectible, right? The losses that we might face due to persons not paying us. And this estimate is usually made on previous year's data, on prior year data. right? So you'll see what happened last year. How many accounts receivables did we have? How many sales did we have? How much of those was cash and credit? And how many persons paid us or didn't pay us or took a while to pay us, right? So that's the premise of the allowance method. So, but what are the steps in the allowance method? So it says the allowance. So we're making some form of allowance or provision in this method, right? So the first step is to estimate the uncollectible accounts at the end of the accounting period. So what this is, remember, this method is based on an estimate, and our estimate can be made based on our percentage of sales or based on the aging of our accounts receivables. So the first thing we need to do is to make this estimate using either of the two methods, right? So after we've made this estimate, we need to do an entry, right? We need to do an entry to recognize the bad debt expense that we've created, and then to update or to create an allowance for bad debt expense, or an allowance for uncollectible, or an allowance for doubtful debts. All these the same name, the same thing. It's just different names that you can call it. So with this method, we're making a provision. So with this provision, we're saying, okay, for the upcoming year, this is what we're estimating that we're not going to collect. This is what we're estimating that our bad debts will be. Is this figure 100% true? Not always. You might not use it. Everyone might pay you, but the possibility does exist. And in accounting, we need to provide for that. We need to make provisions for if this happens, right? So we make the estimate, we determine what the estimate is, then we journalize it. So we journalize it in our bad debt expense account, and then we either create or update the allowance, the provision for it, right? So we're making it to bad debt because we're saying possibly this will be an expense for the business, right? And we have the provision, and the provision sits there, and we will see the provision sits there until what? Something actually goes bad, a debt actually goes bad. So in essence, this is really you could say, taking resources from your business to put aside to make for a provision, and hence why we're recognizing it as an expense. So we're saying, okay, this is gonna cost us. It's a loss to us, the business. So we're gonna expense this. But at the same time, what we're expensing it for is to make a provision, to make some form of safe haven or put aside, in essence, some form of money just in case this is supposed to happen. So you can look at it that way to get a better understanding of the principle. So we've made the estimates and we've done our adjusting entries. What are those entries? So we remember we said we're recognizing the expense, right? We know if we're recognizing an expense, it's increasing. And when our expenses increase, we debit. So the entry here is, and you're seeing all this slash because you can call it either of these accounts. You can call it uncollectible expense, you can call it bad debt expense, or you can call it doubtful debt expense. So we're debiting the expense account. And the next thing to do is to create or update the allowance, right? And we're seeing where we credit the allowance. To update the allowance, to increase it, or to create it, we credit. The next step after we've made the entries is that our expense account is closed out to our income summary. So let's pause there. If we remember our financial accounting cycle, after we've done our adjustments, then we do the adjusted trial balance, and then we move to our final statements. After our final statements, we do what is called the post-closing entries, and we do a post-closing trial balance. And in that part, we close all expense accounts to our income summary at the end of the period. And remember here, we would have estimated the uncollectible accounts at the end of the period, right? So because we did that, we have to close out all expense accounts, and bad debt expense needs to be closed. So how we do the post-closing, we close all our expenses to the income summary, right? And after we've done that, so it says the expense account is closed out to the income summary, and the allowance for doubtful debts, the provision account, is shown in the balance sheet as a deduction from your receivables. So you will see your gross receivables figure. Then you will see a subtract or a less allowance for doubtful debt, right? Coming from the receivables for you to get your net receivables value. So this is what the balance sheet looks like. So you would have had cash and everything else in your balance sheet, right? Then you would see accounts receivable. You're seeing the value here because we're going to be doing some form of working. So we do our working in the innermost column. Then you see less allowance for uncollectible accounts, right? This could be allowance for bad debt, allowance for doubtful debt, same thing. So you subtract this figure from your accounts receivable, and the net figure is what goes to your farthest column to be added with all your other assets to get total assets, right? So continuing in the steps, so we would have made a provision, but what happens when a debt is identified or goes bad? This is what happens when an account is deemed to be uncollectible. What happens when someone can't pay you, right? The asset, which is the accounts receivable, that asset is now useless, and you should write off that debt that is owed to you, right? And how do you write that off? We would have made an entry. An entry has to be made to write it off, right? And we would have made a provision before. So remember, when we made the provision, we debited bad debt expense and credited the allowance. So because we made that provision, now when something goes bad, we pull from that provision, right? We credited to increase the provision. So when we're pulling from the provision, what we have to do? We have to debit. So the entry is, as you're seeing here, to debit the allowance, to debit the provision. And because we're writing off this receivable, we're crediting the receivable. We're reducing what is owed in the receivables balance, right? So let's look at the direct write-off method. So that was the allowance method, and we're now looking at the direct write-off method. So as you would have seen, the direct write-off method, no allowance account is created, no estimate is needed. But the bad debt expense is only recognized or is not recognized until it has been determined that an account is uncollectible. Until it has been determined that an account, the debt has gone wrong or has gone bad. So in this case, it says we're not making an allowance, we're not making a provision, we're not making an estimate. What we're doing is, when the time comes and we know, okay, this person is not paying us, we're just going to write it off. And how we write that off, the entries is to debit the bad debt expense because we didn't have a provision, and to credit the accounts receivable, right? Note, an important note, the allowance method is preferred for the direct write-off method as it is more in line with the matching concept, right? The allowance method, in regards to the accounting standards, it follows that. But some businesses choose, for whatever reason, to use the direct write-off method. And the difference between the two, the main difference, is that the allowance method, a provision is made. And then when a debt goes bad, you pull from the provision. In the direct write-off, no provision is made. So when the debt actually goes bad, all you do is to recognize that debt going bad as an expense, right? But what happens? What happens when you recover or receive payment for a debt that you are written off? And this is a part of many businesses, right? So you sold some goods, and after long periods of trying to get your money, you see that, okay, this is coming to no avail, and this is wasting resources by using a lawyer, etc. So what I'm gonna do, I'm just gonna write off this debt. And you went through all the process of writing off. But then a few months or sometimes years pass, and this person decides to pay you. What do you do, right? So let's look at that under the allowance method. So remember, under the allowance method, you would have made a provision. You made a provision by debiting the uncollectible expense account and crediting your provision or your allowance account, right? That's what you do to make the provision. So when the debt goes bad, what you do next is to pull from the provision. And you pull from the provision by debiting the allowance account and crediting the accounts receivable. So now we know those two. Then, when you have recovered or received this payment, what you have to do, you have to reinstate the accounts by reversing the entry you made to write off the account in step 2. So here in step 2, you wrote off the account. You took from the provision and you cleared it up. I'm not going to pursue collection from this person anymore. I'm just going to take it as a loss and pull it from the provision that I made for situations like these. However, now you would have gotten payment. So what you need to do is to reverse, to reinstate what you did in 2 by pulling from the provision. Now you have to put back the money that you took from the provision, you have to put it back, and you have to increase the receivables to bring it to its original state of the person owing you. And this looks like debiting the receivables account, the customer's account, and crediting your allowance. Why? Because before we would have done the complete opposite. So to reinstate it, we have to reverse what we did. So reversing what we did puts this person back in a position of owing you. But they don't owe you, they have paid you. So after you reinstated the account, what you need now to do is to record the collection of payment. And this is just as how you would record any collection of payment. We do that by debiting cash and crediting now the accounts receivables account, right? What does this look like in the direct write-off method? Remember, in the direct write-off method, you would have just expensed the bad debt, right? You would have done that by debiting the expense account, the bad debt expense, and crediting the receivables, right? So what we need to do again, you would have to reinstate the account by what? Reversing the entry you made to write off the account. So what we're doing is we're doing the opposite of what we did in 1, the opposite of what we did, right, in here. So we would have debited the expense. So now to reverse it, we have to credit the expense, and we would have credited the accounts receivables. So now to reverse it, we have to debit the accounts receivable. So now we've brought back the accounts to its original state of someone owing us, of this person owing us. So now that we've received payment, what do we need to do? Record the collection of payment. And that's the same. Debit cash and credit your accounts receivable, right? So because of this, because of the possibility that exists where persons may or may not pay us and things will happen in the normal course of life. For varying reasons, persons might not be able to pay us. They might die, they might go bankrupt, they might just don't want to pay us, or they might not have the money at the time. So because of this, businesses have to consider, will we be making a provision, or will we be just waiting, sitting it out for someone to tell us they can't pay us, or when payment is due, after us telling them, okay, we'll credit you this amount are good, but here's our terms, you have to pay us in 30 days, in 20 days, right? Or we'll just sit and wait out that 30 days and then we pursue action. So this is a lot of things that businesses need to think of and think about when they're deciding to credit persons. So because of this, you need to manage your accounts receivable. And here, having accounts receivables, it means that your cash is tied up and not earning revenue. What it means, your cash is tied up. You would have sold these goods, and this sale, you should have received cash for it, right? So you're tying up your cash in something to receive in the future. And because of that, you need to offer, businesses try to offer incentives, right, to encourage persons to pay, to encourage prompt payments. And these incentives might look like discounts and deals, right? Discount, if you pay before this time, you get a 5% discount. If you pay before this time, we might add something to this deal. So the business have to be creative rather than having a loss of receivables and the possibility that you might not get payment, right? So managing your account receivables is very much important. So with that, we're going to be looking at a question, and we'll be looking at a question in our next video. So stay tuned for that. We're looking at a question on how we go about making these provisions. What can happen? What if we pull from the account and then someone comes back and pay us, and all the different situations that might happen. So stay tuned, look out for this video. And as I always say, like this video, share with someone. Remember to subscribe to our channel. Comment if you have a question or a query, or if you just want to give us a shout out just to say something. You can always send us an email. Our email is right there. And you can follow us on Instagram. So thank you for watching, and I'll see you in our next video.